Hello everyone. Thank you so much for joining me today at the eStreet Cap channel. Today I want to talk to you about something very exciting that I just finished analyzing. It's about understanding if it makes sense for you to add venture investments as part of your investment strategy. Before we move forward, I want to highlight that nothing that we talk about today is a recommendation, solicitation, or an investment advice for your specific situation. Everything that we talk about today is only for informational purposes and educational purposes only. With that, let's get into the study. Before we get to the study, a couple of words about eStreet Cap. We help companies with their investment banking and financial advisory needs, and we also help accredited investors and institutional investors invest in the venture stage funds, as well as investing in fund of funds. So if you have a reason to get started in the venture world, please feel free to reach us at contact@estreetcap.com. Okay. One of the best known risk mitigation strategies that is out there is diversification. For most folks in the financial world, you know that diversification is pretty much close to the free lunch that you will get in the investment world. More on diversification itself will be in a separate video, but in case you have any questions, again, feel free to reach us at the email that I provided. We looked at venture stage returns over the last 20 years, and we used Cambridge Associates Venture Index as a proxy to measure the returns. And we see that for the last 15 years or so, the returns have been pretty consistent, and I think they are actually less volatile in the last 15 years or so, even lesser than the market for some periods of time. But the biggest thing is that the correlation between the market, which in this case we are using SPY as the ETF to measure the market performance, the correlation between SPY and the venture index is very low. It is only about 0.35 to 0.5, which is good in case you want to diversify. Before we move on to the study, I also want to talk a little bit about the efficient market frontier. This is a theory that was proposed by Markowitz in the early 1950s. And what that really states is that if there is a set of assets that we have and we construct various portfolios using only those assets, a rational investor would always choose the portfolio that offers higher return versus lower return for same amount of risk. For example, in this case, the portfolio L is going to be suboptimal as compared to portfolio H, which offers higher return and still lower risk. If you look at this curve that is out there, which is the efficient frontier, and I were to draw a line from the risk-free rate to the edge out here, which is really the optimal portfolio, I get what this line is, what we call as the optimal capital allocation line. That's kind of the primer on this theory. We used a little bit of this, so I want to touch upon this. Again, we'll cover more of this theory alone in a separate video. So what we did was we looked at only two assets. We looked at the market, we looked at the SPY ETF performance, and we looked at the Cambridge Associates Venture Index. And in that hypothetical portfolio, we constructed various weightages for these two assets, and we looked at the returns and the risk over the last 20 years or so. And what we find is that If you would have invested only in the market, the results would have been suboptimal in the sense that although you get lower risk as compared to something like here, but you also get lower returns. And if I were to draw the capital allocation line as I talked about it in my prior slide, I see that the tangent portfolio would be about 15 to 20 odd% of venture investments. In other words, if you would have added 15 to 25% of venture investments in the portfolio, the results would have been more optimal as compared to investing only in the market. One point I want to highlight is that we went back to 1999. From 2000 to 2002 was a very bad year for venture investments. So we decided to look at data points since 2006. And if we were to do that, we see that the market-only investment was way suboptimal as compared to the tangent portfolio, which actually has a lot of venture investment in this specific case. And the reason for that is that the market as such saw a major pullback from 2007 to 2009. So to keep the level playing field for both the asset types, we look at data from 2010 onwards, and in this case as well, we see that the market-only investment is suboptimal as compared to the portfolios where venture is part of the investment strategy. And the tangent portfolio has close to 55% of venture investment as a strategy. So depending upon the assets that are considered, depending upon everyone's unique risk tolerance, a performance that is more optimal can be created using venture investments. Just to demonstrate that, what we also did was, instead of looking at only two assets, we looked at, we added a third asset. In this case, we added Berkshire Hathaway's performance over the last same time frame, 20 years, 15 years, and then since 2010. And with three assets, the results are pretty similar. We see that market-only performance is suboptimal as compared to when we add some amount of venture investments. Even if we go back to 1999, about 10 odd% of venture investment would have yielded more optimal results. And if we go back to 2010, again, the venture investments do help a lot in terms of creating a more optimal portfolio. The reason we looked at Berkshire was that the correlation of Berkshire's performance with the venture investment is negative or close to zero during this time frame that we conducted the study on. So to summarize, if we were to just go by the study that we did, adding venture investments can add diversification and help you build a more efficient portfolio. Again, this is based on the study alone, but everyone's unique situation related to risk tolerance and reward considerations will define ultimately what you decide in terms of your investment strategy. Regardless to say, there is a lot of there were a lot of limitations in our analysis, specifically the fact that we only looked at venture investment performance via the lens of Cambridge Associates Venture Index, the US Venture Index, as a proxy, which in itself is not a realized market result. So, this is only for educational purposes, and again, the past performance is not indicative of the future performance, and the correlations that existed in the historical period might not hold true in the future periods. And there are several other limitations as well. With that, I would like to thank you for tuning in today. And in case you want to get started in the venture investments, whether as a venture firm looking to help on financial advisory, or as an accredited or institutional investor looking to invest in some of these venture stage companies and the E Street Cap funds, do let us know. Thanks again, and I'll see you around for another of my videos. Thanks.